Okay, Rachel, let's play a game. A JVC apartment delivering 7% yields plus 5% appreciation for a 12% total annual return. Nice, right?
Solid. Very solid. What's the catch?
The catch is a Palm Jumeirah villa at only 5% yield, but with 12% appreciation, hitting a massive 17% total return. Today, we're helping you choose between cash flow and appreciation for Dubai 2026.
Welcome to Dubai Daily, your essential morning briefing on Dubai's real estate market.
I'm Mark.
And I'm Rachel. Today we're breaking down two core investment philosophies, income versus growth, with insights from our friends at Property Monitor and DXB Interact. This is episode 58.
All right, let's get into the fundamentals. We're talking about two very different mindsets. The cash flow strategy is all about immediate income. Your rental yield needs to be higher than your costs. Mortgage, maintenance, all that good stuff.
It's the money in your pocket every month approach. On the flip side, the appreciation strategy is the long game. You're buying an asset you believe will be worth significantly more in 5, 10, 15 years. You're betting on capital gains.
Exactly. But the smart investor looks at the total return framework. It's simple. Rental yield plus capital appreciation equals your total ROI. For 2026, the market is shifting from wild speculation to solid fundamentals. We're looking at a moderate 5 to 8% appreciation and very stable 6 to 9% yields.
And here's the Dubai cheat code, the zero tax multiplier. Zero capital gains tax, zero income tax. That gives you a 40 to 50% advantage right out of the gate compared to investors in London, Mumbai, or New York. It turbocharges both strategies.
It really does. So let's dive into the cash flow camp. Who is this for, Rachel?
This is perfect for passive income seekers, retirees who want a steady paycheck from their assets, or anyone who just wants their mortgage covered by the tenant from day one. It's about creating an income machine.
And where are these machines being built in 2026?
You're looking at communities with incredible demand and rental performance. International City is hitting 8 to 9% gross yields. Jumeirah Village Circle, or JVC, is a powerhouse at 7 to 9% for an 80-day $1.5 million entry point. Even Dubai Investment Park is pushing 9.5% because of its proximity to the industrial zones.
Wait, don't forget Dubai South. That's the one everyone's watching. With the airport expansion, early movers are seeing 8 to 12% yields. But let's be clear, we're talking gross yields. What's the reality?
Great point. Always deduct 1 to 2% for reality. That's your service charges, maintenance, and potential vacancy. So a 9% gross is more like a 7 to 8% net yield, which is still fantastic globally. Typically, studios and one-beds are your highest yield performers here.
The major trade-off, of course, is that these areas might see lower capital appreciation, maybe 5 to 8%, compared to the prime spots. So let's talk about those prime spots. The appreciation strategy.
This is for the long-term wealth builders, people with low liquidity needs who want to park their capital and watch it grow, tax-free. They're not worried about monthly income. They're building a legacy.
And the locations are iconic. We're talking Palm Jumeirah, where villas are forecast to see 12 to 15% price increases. They just had a record $600 million sale there last year. Then you have Emirates Hills, the benchmark for ultra-prime, with 8 to 12% appreciation and essentially zero correction risk, according to Knight Frank.
And it's all driven by scarcity. You can't just make more beachfront land on the Palm. Add in major infrastructure projects like the Metro Blue Line, which historically boosted rental demand by over 20% in nearby areas, and you have a recipe for growth. Dubai Creek Harbor is another one, with 10 to 15% off-plan appreciation because of its amazing master plan.
The property types here are different too. Villas, townhouses, waterfront properties, they consistently outperform apartments for capital growth. You'll get lower immediate yields, maybe 4 to 6%, but the long-term wealth creation is on another level. Remember, that 15% growth is 100% yours. No tax man cometh.
So, do you have to choose? Or can you be greedy and have both?
You could absolutely be greedy. That's the balanced portfolio, the hybrid strategy. A common approach is a 60-40 allocation, 60% in cash flow properties and 40% in appreciation assets.
Let's put numbers on that. Say you have an AED $10 million portfolio. You could put AED 6 million into a few apartments in JVC and Business Bay, generating around AED 480,000 in annual rent. The other AED 4 million goes into a Dubai Hills townhouse, which gives you a decent 5% yield plus that juicy 10 to 12% appreciation.
And that's how you manage risk. The cash flow from the apartments covers all your expenses, even during a market dip, while the townhouse quietly builds your long-term equity. It's about diversifying across 3 to 5 communities to avoid localized supply risk.
So let's tie it all together with that total return calculation. For that JVC apartment, a 7% net yield plus 5% appreciation gives you a 12% total annual return.
And for the Palm Villa, a 5% net yield plus 12% appreciation gives you that incredible 17% total return. The numbers tell you which path you're on. The key is matching the strategy to the investor.
Exactly. If you're a retiree, you're probably 80% cash flow focused. You want that income from JVC or Dubai Silicon Oasis. If you're a young professional building wealth, you might flip that to 70% appreciation, looking at off-plan in Dubai South or Creek Harbor.
And before anyone gets too excited, a quick reality check on net yields. You must deduct service charges. That's AED 15 to 25 per square foot annually, plus maintenance, vacancy buffers, and any management fees. That's how you get to your true net figure.
Okay, let's get tactical for 2026. What are the immediate moves an investor can make?
For cash flow, look at the Q1 2026 rental spike. January always sees a 5 to 10% boost from corporate relocations. Focus on ready mid-market properties for immediate income and to avoid off-plan delays.
For appreciation, think infrastructure. Projects in Dubai South are forecast for 15 to 20% growth, and watch that Metro Blue Line corridor. But manage your risk. JVC has a huge supply pipeline of over 64,000 units, so limit your exposure there to maybe 30% of your portfolio.
Let's nail this down with a quick case study. Investor 1 is a cash flow queen. She buys a AED 1.5 million one-bed in JVC. Her 7.5% net yield gives her AED 112,500 a year. That covers her AED 80,000 mortgage payment and leaves her with over AED 32,000 in positive cash flow. Her 5-year total return is a very healthy 62.5%.
Now for Investor 2, the appreciation king. He buys at AED 10 million Palm Jumeirah villa. His 5% net yield is still a massive AED 500,000 a year, but the real magic is the 12% appreciation, which adds AED 1.2 million in equity annually. His 5-year total return, according to Savills' latest report, a staggering 101%.
2 different paths to 2 very successful outcomes, which brings us to our key takeaways.
First, stop thinking about just yield or just growth. Total return is the only metric that matters. Second, your investor profile dictates your strategy. Don't chase appreciation if you need monthly income. Third, Dubai's zero-tax environment is the ultimate amplifier for whatever strategy you choose.
And finally, be tactical in 2026. Understand the supply dynamics in places like JVC and focus on scarcity and infrastructure-linked growth.
That's your Dubai Daily Briefing on cash flow versus appreciation. A massive decision for any investor, where the right choice depends entirely on your personal financial goals.
If you're trying to figure out which strategy fits you, we highly recommend getting in touch with an expert who can guide you.
Dubai Daily airs every Monday through Friday at 7 a.m. Dubai time. Subscribe wherever you get your podcasts so you don't miss an episode.
Until then, invest wisely.